housing boom, it's pretty much over. In fact, economists are predicting that Canadian home prices will fall by as much as 20% this year, as rising interest rates have pretty much poured just cold water all over Canada's hot housing market. Mortgage rates are expected to keep climbing as the Bank of Canada will aggressively raise interest rates just so it can try to tackle our runaway inflation problem. And as these borrowing costs continue to rise, this will have a significant price drop on some of the hottest markets in the country. This is the state we find ourselves in today, a stark contrast to just maybe 2.5 months ago, where the housing market was booming, where we're seeing multiple bidding wars, bully offers, and now people are all just talking about price drops, sales dropping, and buyers just not interested. In fact, another economist, this one from TD Bank, is forecasting prices will fall by at least double digits by the end of this year. The general feeling is that the housing market correction is no longer just a what if story anymore. Now the question is how much the impact will be and how long will this downturn last. And as I talked about in my last housing video, by the way, if you haven't watched it, make sure to check out this right now and maybe come back later to this video. Anyways, what I talked about was that how much prices have fallen, especially across Ontario. Oakville-Milton were the hardest hit areas. Cambridge and London not too far behind. Now, based on when you watch this video, a couple of things may have already happened or are just about to. The Bank of Canada is expected to raise interest rates in June by 50 basis points. There's even talk that we may get a surprise increase of 75 basis points. So, if it's already happened, make sure to let me know in the comments of what that turned out to be. The market has changed overnight as these interest rate hikes are coming through. There are homes that are sitting on the market without getting any offers and now are just sitting there waiting. Compare that to just a few short weeks ago, or even just a couple of months ago, where there was so much hype that some sort of housing is about to come soon on the market. There were offers even before it would hit the marketplace. Multiple realtors were hyping up on their social media platform about the next best opportunity. Buy in before prices keep going up. This has all changed. Multiple bidding wars, gone. Multiple offers, gone. This is a completely different market. It's crazy how things can change so drastically. The pandemic housing boom is clearly winding down. What's going to happen next? Well, I'm glad you asked. First of all, bidding wars are easing and prices are actually starting to either decline or are at least flattening. In simple economic terms, when any market, they overshoot like we've seen with our housing market, especially in the last 2 years, it has to correct. And it oftentimes does, just like what we're seeing now. The pendulum is about to swing into the buyer's market territory. Now, depending on where you are, because this is a wide country, from Toronto to Halifax to Vancouver, you may already find yourselves in a buyer's market. The crazy frenzy of the housing market that we were all used to and all we became accustomed to has just disappeared overnight suddenly as these rising interest rates have come through. What's interesting for me personally is that I've been making these housing videos for the past 2 years, and I've been talking about different metrics and different economics on how high the housing market was going, how much this froth was building over, when will this froth disappear? And I'm at a point where we're talking about declines. The froth is going away. It's really a stark contrast compared to some of my older housing videos. There's one metric when it comes to the housing market that's very important that you learn how it works and you learn how to pay attention to. This important metric is called the sales to new listing ratio, or SNLR. And all this means it's just a method of determining, relatively speaking, inventory levels. It's the share of homes sold compared to the newly listed homes for sale. And a higher SNL ratio means that there are tighter inventory levels compared to buying activity. And data from the Canadian Real Estate Association is showing a sudden drop in this very ratio. The SNLR ratio fell to 66% in April. That's considerably less than the average we saw over the last year, which was around 76%. What does this drop mean? It tells us that inventory levels are starting to rise, that the demand for homes is starting to dissipate every single week, almost every single day. Now, unless you bought at the market peak back in February, this is considered a healthy decline. This is a decline that was desperately needed in the marketplace. According to BMO, we are on the cusp of a balanced marketplace. And what's really interesting, at least at the national level, there's this sudden shift from a very hot market to close to a balanced market. However, the market with the lowest ratio is in fact the Greater Toronto area. Surprisingly or unsurprisingly, depending on where you fall on the housing market real estate spectrum, one of the world's biggest real estate bubbles in the entire world has the lowest demand in Canada right now. Why would you want to buy a home right now when you know for a fact that in a week, in a day, or in a month from now, that home is going to be worth considerably less based on how these interest rate hikes are going. Here's the thing, in a bubble, home buyers are driven by emotion and end up paying an emotional premium just to participate or keep participating in the housing market. And we've seen these emotions take over in the housing market that were forced to drive prices ever higher. Where do we see prices going from here on out? Well, do yourself a favor, hit that like, subscribe, and thanks button found on the bottom of this video. That way you can stay on top of all the news, facts, and data coming out of our housing market. With a market like this, you want to stay in the know. So do yourself a favor, hit that like, subscribe, and thanks button. And now those very same emotions of missing out are turning into regret, especially for buyers, especially for first-time home buyers who end up buying at the peak or near the peak back in February. In fact, I released a video earlier on in the year on why this is a bad time to be buying a house right now in 2022 as the market was peaking. And before that, I talked about how the average price in 2021 was going to pale in comparison to 2022 as the prices were expected to drop. And at that time, a lot of people were questioning, well, you actually think the price will drop? Housing, doesn't it just go up and keep going up? Well, here we are today where we're seeing thousands, tens of thousands, hundreds of thousands of dollars prices falling out. And if you've been following the channel, you know we've been talking about the prices headed for a peak and the potential for those same prices to fall off a cliff. And that's exactly what's playing out right now. A wave of buyer's remorse is taking shape, especially in some of the hottest real estate markets, after prices are falling and sales are dropping, especially over the last 2 months. Realtors and lawyers across Toronto and Vancouver are getting multiple calls a day from buyers, from frustrated buyers, on what options do they have, how can they get out of that purchase. And sellers are hoping to ensure that these deals do go through as conditions have dramatically shifted from the previous highs in that crazy frenzy that we just saw. The country experienced a 26% drop in the number of homes sold over just the last year, and close to a 4% drop in housing prices as we shifted from March to April in just that 1 month. And with the real estate conditions we saw leading up to February, it's almost like you can draw a line in February where the market sort of shifted overnight. There was no option but to go all in. And if you did go all in and suddenly you realize that maybe that wasn't the best idea, and if there's a way to get out of that bad bet, you're going to do whatever it takes to try to get out. Is the seller really willing to go through multiple years of chasing the courts only to find out that they get a judgment that cannot be pursued? These are the very real questions that both buyers and sellers are asking themselves as prices continue to fall. Now, in cases where you, the buyer, has already put money into the seller's trust account, that money can only be released either through a court action, the closing of a deal. If a deal ends, brokers can actually sue for lost commissions, but it's not a path that a lot of brokers will take because generally it's not a good look to take legal action against your client, especially if they turn to you again to help them sell their home again after that failed transaction. Monetary policy is a blunt tool that the feds have when it comes to raising interest rates. It doesn't always work immediately, especially when it comes to fighting inflation, and housing is no exception. But we're just starting to see that impact of those higher mortgage rates and how they've cooled the housing market. This is having a very real impact on the buyer's ability and willingness to compete in the housing market, which is also leading to slower sales. Inventory levels are rising and we're seeing an uptick in the number of home sellers. This is now a fact that's driving more and more homes available on the open marketplace. We're seeing more and more sellers and a bit of a more cautious approach from buyers, waiting to see how the housing market plays out before taking more concrete actions. As buyers are grappling with these conditions, we're actually seeing some of them decide not to buy, put those plans on hold, and rent, at least in the short term, to see how this market plays out. As I mentioned earlier on the video, that the housing prices fell 4% going from March to April. And in April, the housing market fell an additional 6%. The average prices peaked back in February at $816,000. And now for 2 consecutive months, we've seen the prices fall, not only fall, but fall faster with each passing month. The average price as of this video stands at $746,000 right now. How much lower will this price go? Local housing markets in many parts of Canada has just cooled off, and this is in line with not only the rising interest rates, but just buyer fatigue. And if we were to take a look at Toronto specifically, the average price is down by more than $80,000 compared to March. Now, if you were to ask me right now, is this considered to be a buyer's market? I would say not yet, but I feel like we're definitely headed that way. Before 2020, the idea of spending millions of dollars just to live in the far out suburbs of the GTA or the GVA would have seemed like a crazy idea to most home buyers. Then the pandemic hit and the market shifted, and that's exactly what everyone wanted to do. Go out in the suburbs and buy the biggest home that they could fetch. As our world became more and more online, And our homes became our home offices, they became our gyms, they became essentially everything. Now, the market is shifting once again, this time with prices and demand falling. Some buyers are experiencing an overwhelming amount of buyer's remorse and are trying their hardest to get out of deals. First, we had FOMO, and now what we're seeing is kind of like reverse FOMO. People are all of a sudden talking about prices falling like $20,000 a week in Milton, Ontario. Now, if you're looking to get into the housing market right now as a first-time buyer, these numbers may actually excite you that prices are falling. But if you were to take a deeper look, this is also very impactful. As when enough people hear this news, it almost becomes kind of scary to see prices falling $20,000 a week. There are many stories going on right now that where buyers are trying to renegotiate deals because of failed financing as housing prices continue to drop. Which makes sense because buyers don't want to get stuck overpaying for a home that they put an offer on maybe a few weeks ago, maybe just a few short months ago, and come closing time, that home is worth less, plain and simple. Detached homes in the 905 region in particular saw a significant drop, with average prices falling more than $200,000 from February's numbers. Semi-detached homes fell by close to $172,000, townhomes by $120,000, and condo apartments so far have dropped by $35,000. And for buyers who are trying to renegotiate a deal, not only are you risking losing your deposit, but you're also risking an expensive and drawn-out legal battle in courts. It's not just about risking your deposit, it's about this cascading domino effect, where one buyer renegotiates a deal and that seller, well, has to accept less money in order to close out on their next property. And this sort of chain reaction has the potential to clog up money in the housing market, and this is a really bad time considering we're also facing high inflation. Because you don't want your money to be clogged up in a legal battle, you don't want your money to be clogged up in a deposit, you don't want that money to be locked up for a couple of years because you also have to pay for operating expenses to maintain your existing life. Unfortunately, there are very few options available for buyers who've purchased a property with no conditions and especially no financing conditions. And due to these rising interest rates, some buyers are finding themselves in a position where they are shy of more than $100,000 of what they need in order to close a deal. At that point, your only option may be to get a second mortgage from a private or alternative lender. And if all else fails, you can try to negotiate a mutual release, but that means you are risking your entire deposit. Needless to say, there is definitely a fear of getting screwed right now that's taking over. In real estate faces several hurdles right now, and those hurdles may rise even further. Rising interest rates is one thing, but the amount of debt Canadians have already taken on is insane. Canadians owe collectively $1.99 trillion in mortgage debt, a number so large that it almost becomes meaningless. And the crazy thing is, this number is up $190 billion compared to just a year ago. Like, this is an astronomical number considering the size of our economy. That number is so large that it's just crazy to think about. For comparison, that number compares to like 97% of our GDP. When the size of mortgage debt is so high, it has a potential to slow down the entire economy. And now there's a potential for this expensive housing market to cause a recession, which is something that we all don't want. In other words, we all got really greedy, drove up our housing prices to insane levels, and now are facing regret. And the path forward is not looking that good either. So make sure you hit that subscribe and like button so you can stay on top of all the news coming from our housing market, because where it goes next is going to be crucially important on how it impacts you. Thank you so much for watching. Make sure to check out all the links in the description below. Some amazing discounts and sign-up bonuses worth hundreds of dollars in free money. You can now also sign up for a channel membership to show your support, get behind-the-scene updates, and provide direction for future content. That's it for now. I'll talk to you in the comment section.